Okay, very good evening to all of you. So we start our monthly market update sessions of February, and we have taken in last 30 days two offline seminar also. One is in Calcutta, one is in Faridabad. So in the month of March, we will be having a session in Delhi also. So those who are in and around in Delhi, they can able to join me in that offline physical seminar. We discuss about market and all. So today, as a normal traditional template, we go through our monthly market updates, what's happening in India, and where we see market will move from here. We'll discuss in that thing. Okay. So our structure of presentation will remain the same. We'll discuss about global economy, US economy, then Indian economy, followed by Indian equity market, gold, and lastly, we will summarize what we feel that market will happen going ahead. Now, we have a budget session in the beginning of February, and although I have discussed in details in a budget session in my seminars, in my earlier seminars, so today we will not touch base upon in details of budget, but few glimpses of those budget presentations will be there in my presentations. So we move on with the global economy first. Now, world prediction for 2025, which the data has been analyzed, and it says that global average temperature will increase is a negative. Many more people will live in their virtual worlds, neutral. People in my country become more tolerant to each other. It's negative. Conflict in Middle East will end in 2025. It's also negative. Okay, so I'll just give you a brief about what's the prediction is going to be here. Fiscal consolidation in major global economics is going to happen. So the data stretches from 2005 till date, and you have seen US, Japan, and Eurozone. So there are a lot of consolidation were expected to happen in days to come. Global monetary easing with few exceptions. So if we see the rate cuts are happening, a lot of countries are having rate cuts, and India is off late. This data is as of 31st January. So India, last week we have seen there's a rate cut happen in India. So India will also go towards the rate cut as for the emerging market economic goals. So if you see, most of the countries are having these rate cuts of late, and it is in line with what is happening at global. But apart from that, what the major exceptions here lies in the US, where we don't see the rate cuts happening. Why? Those things you will see in a subsequent slides. Global PMI is still weak. So data says that 100 basis points of policy easing anticipated in 2025. Now, this is a big data, like 1% total rate cuts you are going to have in 2025. Okay, so we have seen 0.25% rate cuts happen in India. So we are expected more rate cuts to happen in days to come. Obviously, with the US aggressive stance on tariff and all, the central bank in India as well as the other countries will have to do the rate cuts to keep their economy and their equities in the market moving. US and China trade has reduced. So US import major market share since 2018. So if you see the major market shares in 2018, like China, they have the major market share. The latest market share is 10.6%. You see the kind of percentage that US have with India's only 2%, major market share since 2018. Chinese export major market share since 2008. So China also export a lot. US 14.5% and US import from China is 10.7%. So this data is actually shows you that why US is wants to have a balance of trade between different countries. Okay, so that's what they are doing this thing. And this data says that US and China trade has reduced. Now, US is a long history trade protectionism. So what we are seeing right now is that a lot of US rates, tariff rates are being higher. A lot of concerns are being raised about why tariffs are getting too much of, and because of that, the stock market is also reacting. But this data is way back from 1800. Now, if you see the data from 1800, like we have seen the US as a history of trade protectionism. Okay, so obviously last couple of decades we have not seen that. Of since Trump has come into place, we have seen aggressive rate tariff policies and rates are being hiked in last 10-15 days. But if you see the long data from 200 years, like US have this trade protectionism policy. Now, 10% US tariff hike on China may cut its Chinese GDP by 50 basis point. So that's what they're expecting about that. China's debt burden on the other side is higher than the US and Eurozone. The data clearly says that. China's corporate profit declined for a third year in a row. So this is a good point that China's corporate profit are in a decline in a third consecutive year. So change in the China's corporate revenue and profit. Now, quarter of Chinese companies with revenue over PNB 20 million reported losses. So that's the data point that's in front of you. Now, that's what, so if we summarize what's happening in global economy, we are seeing that US and China trade has reduced. Most of the countries, emerging countries, as well as the developed nations are reducing interest rates, bearing US we will see right now. China debt burden is much higher than the US and Eurozone. And what we have seen is that there is a there is a trade US trade, protectionism, which we expect that US usually have a free flowing thing that is not there. If you see the 200 years of data, US has always been protectionism towards its people and a country. Of late, last 20-30 years, we have not seen that. So that's what happening in the globally front of you. Now, coming back to the US economy, now Fed is maintaining a very delicate balance between growth and inflations. Okay. Now, US national debt surplus is 36 trillion. Now, this data is important. Why we are saying that US has a huge amount of debts which has already been there. Okay, so if you see the debt per citizen is $107,112, which is huge. US federal debt to GDP ratio is 122.94%. So what that means is that for 1 rupees of US increase in national debt, like 1 rupees in GDP, they have to take a debts of 1.22. So that huge amount is happening. Now, if you see that GDP increases matches with debt increases. So that's a very crucial point. Now, whenever they are increasing the GDP, their debts are increasing. So that's very critical. Why I'm saying critical? Because large amount of US bond will get mature in next 3 to 4 months. And right now, because of their high debts and also because of the high inflation, why there is a US high inflation? Because obviously, if you put tariff 10%, 20%, 30%, it will increase your cost. Now, you have also seen that Trump is putting up those immigration policies. So that will also increase the wage factor. And plus, he has not reduced the corporate tax. We are not expecting him to reduce the corporate tax because he's coming from the business background. So all this thing will push up the interest rate more. With a huge debt that US is having and a higher inflation rate, imagine all those bonds paper which will going to mature in 3 to 4 months. They will have to reissue at that higher rates, which will put a more pressure on the US. This debt, US national debt, will surpass more if you see the data 6-7 months from now. So that's a very critical situation. And exactly why I'm saying this thing, that's why I'm saying lower rates are needed to service higher debts. Treasury has some 10 trillion of debt to refinance in 2021, just as bond yields so high. So that's why I'm saying the Treasury has 10 trillion of debt to refinance. 3 से 4 महीने बाद उनका डेट्स मैच्योर होंगे, जो पुराने जो डेट्स पेपर थे 10 साल के गवर्नमेंट बॉन्ड से. Now there has to be in a higher rate. So what I'm saying that they have to lower rates to service the higher debts. What they are not able to do because the inflation will be higher. Now, investor had poured money in US equity market. Now, if you see in the last 10 years, like last 10 years, or in fact in the last 5 years, US huge amount of money is put in the US. So see, this is the data point, like big allocation to US equities in the 2020s. Like this is the 2020s and 2025. Now, see how much of money is put into the industry, $1,200 billion, whereas in the rest of the world is $215 billion. So huge amount of money in a total market capitalization in the world economy. If I take into consideration, like out of the total world economy, 60% is right now the money is lying with the US. Now, that kind of money investor pour into the US economy. And that's very critical kind of thing, because the country which having a huge debts, they're expecting market to outperform, but that will not going to happen. And that is the reason next slides will tell you, this slides, corporate insiders started dumping share at record space. Now, this is the data which I want to tell you is that insider informations reveal that there's a huge sell-off happening in the big corporates. And that is the reason if you see the huge US stocks that have started declining in the last 15, 20 days. US stocks have outperformed in the last 10 years. So if you have invested in US stocks, you have made a huge amount of money. But last 10, 15, 20 days, you see that this corporate insiders started dumping shares because they know that these data point, like huge debts and these data points, 60% of the market capitalization with the huge amount of allocation to US, with their economy in India doldrum with a high interest rate and high debt burden, this is going to come down. So this data is saying gap between US earning yields and bond yields suggests equities are overpriced. So any market, be it India, be it Europe, be it US, how you can see that whether your stock market is overpriced or underpriced, you have to see your bond yields, 10-year bond yields versus earning yields. So that's where you can actually get into price. So when we see the US earning yields with the bond yields, it says that equity overpriced. And that's why they started selling off those big corporate house insiders. US had disproportionate share in global market cap. So that's why I'm saying 65% market capitalization is US is having. That is a quite disproportionate share in the global market capitalization. Now that's what we talk about US. US is in huge debts. Their bond are going to mature in 2 to 3 months from now and there also inflation is on a higher side because of the factors which Trump is taking. And as a result, they will have to renew their bonds in a much higher rates. The equities in the US has outperformed in the last 10 years, and bond yield and earning yield suggest that equity are highly overpriced. And as a result, the insiders, the corporate big short insiders started selling US shares in the last 15, 20 days. And mind it, we have seen that a huge FII outflow have happened from India to the US in last 6 months. And that is the reason, one of the reason why Indian market has come down. Now, if the corporate insiders, they know that the equity are overpriced, they have a huge debt burdens, and that as a result, the inflation will also go high because of what Trump is taking. So the market have to correct in days to come. So all those FIIs which have gone there in US, they will have to come back over a period of time. And when will they come back? Only time will tell. And why? If the FI started coming back, you know where the Indian market will go. Obviously, they will not come solely into India. They will go to different places in the world. But once they come back, you will see the market will go from the next level from here onwards. So the correction which you are seeing in the Indian market is basically because of the global economic factor which is happening. Plus, there are other liquidity factor is there, which we discuss in the Indian economy segment, but which has been mostly addressed by the government and the central bank in the RBI policy, recent policies. Okay, so let's talk about Indian economy. Our dark clouds gathering. So Indian manufacture PMI rises to 6 months high of 57.7 in January. Auto sales up 6.6% in January. India's CAD widened to 1.3% GDP. India's crude oil import from Russia surged 13% in January. E-way bill generation hits new high in Jan. India's growth strong and stable macro standing apart. So if you see India, that's what I'm saying. That is world economic outlook growth. See the India's growth story and the projection and this thing. But important point here to mention is that India with a 6.5% GDP growth will struggle because the kind of population India had, India need to have minimum 8% economic GDP growth to match up with its demand in the Indian market as well as the generate employment. So this budget session, the government has outlined to generate more than 8% GDP growth. Let's see what is going to happen in days to come. But although India looks 6.5% GDP growth, but we expect it has to be more than 8%. If the India is not growing an 8% GDP, then there's a problem for the government, and government realizes that that's a most important factor. Okay, so let's see what the GDP will grow from here onwards. That data will tell in eventual days to come. Economic activity shows growth pickup is sustaining. Capacity utilization likely to pick up in CY 2025. Better monsoon bodes well with Indian economy. Rural demand continue to outpace urban demand. So I've seen the data from over the period of time. Oil price remains subdued. We all know why the reason, because we have taken oil from the Russia at Indian rupees, bypassing dollars. So we have been pretty pretty fortunate out there, and pretty technical things, from the government point of view, to get those at favorable price. And this oil price actually help us to control our fiscal and current account deficit. Okay, so we are in a better position as well as the fiscal and current account deficit goes. GST collection growth exceeded normal GDP in Jan. And this is the reason, and we have seen that over a sustained period of time when the GST was lower. Why GST was lower? Because we have seen that the subdued corporate earnings in last second and third quarter of FY 24-25. Why the subdued corporate earning? Because the market did not have a liquidity. Why the market did not have a liquidity? Because there was a bank interest rate has fallen down from bank growth rate. Credit growth rate has fallen down from 19% to 11% because of some RBI policy. Because what they are seeing, there is a lot of delinquency happening in credit cards and gold loans and all those personal loans, and they bring out some policy. And as a result, you have seen that the much inflow, corporate liquidity was less, market liquidity was less. So because of lower bank credit growth, the corporates profitability, corporates margins was on a flatter side, and that's why it reflected in the the lower GST collection also. But this has turned around in the January and February also. You will see that because we have a rate cut happening, government understand that to push the more bank credit growth from here. So when bank will push more credit into the market, the liquidity will happen. So liquidity was not there in the last 2 quarters, and as a result, the GST was lower. As a result, the corporate result, if you see, was flat in last 2 months, last 2 quarters. And this is one of the reason, apart from FII going down, FII taking out money from India, which resulted in the stock market going down. So this has been addressed somewhat in the budget session itself, to cut CRR as well as the repo rate. India in a strong free cash flow and healthy balance sheet. I told you. You see the net debt to EBITDA is been a low. We have from 16 onwards. This has been a low. So which is a better point. Okay. India is in a capex upcycle. Funding acceleration shows rising capex from private sector. So that's been the data itself shows that government capex on an upward march. So last 2 quarters also, the government was not able to spend because there was an election happening in different, state general election effect on capex. So which has been removed right now. So government is free to do more capex and more capital expenditure in days to come because of the election things are over, and which will eventually show that more government expenditure will happen, and it will eventually push up the GDP, GST collection also. And this will some way or the other, you will see, will make sure that the GDP will rise for more from 6.5% to the higher level. Capex is a percentage of budget estimate weak, but saw some improvement in December 2024. So that's what I don't go into the details of each and every month here. Two-wheeler and three-wheeler trucks, two-wheeler, three-wheeler and trucks well below pre-COVID levels. So one of the more criteria which I see is this tractor sales. Okay, so if you see the tractor sales, this actually tells you how the market is happening, how the economy is performing. If you have a better tractor and lorry and truck sales happening, that actually tells you, the commercial vehicle sales happening, that actually how the state of the economic affairs. So if you see in 2024 right now, and this was the data point as a peak, and this is right now. So if you see in 19, the big commercial vehicle was 0.48 peak, and now it is 0.42. It is still lower side. So we can expect this to rise from here itself. And once this rise, the market is moving, the economic activity is happening more. So keep a focus on how much tractor and lorry and truck sales are happening in the country, whether it is increasing, decreasing, then you can have an idea where the economy is happening and what the movements happening. Yes, I told you last 2 quarters, second and third quarters, market were subdued because the liquidity was not there. Now it will start picking up because of the government recent policy of the rate cards, CRR cards, and everything. So we'll start picking up these two segments also, with the credit growth picking up also. And tractor and truck sales, more important is that the credit growth has to be there, because until unless you have a more robust credit growth happening, these sales will not happen. Okay. Now, state government are turned more populist. Now, the one factor which can hindrance in India's reaching out to a GDP of 8% plus, and all other factor, is that the populist government measures, cash transfer, the Ladla Beti, the Beti Bachao, and all those 1,000 rupees, 2,000 rupees per month, to different families. So that is putting a lot of pressure on the exchequer. If you see the cash transfer schemes that Maharashtra, Telangana, Karnataka, West Bengal, Odisha, and others, they see the amount, monthly amount transfer. So that's what they're exactly doing right now. An estimated cost per year, this is in billion. Okay, so that's the kind of thing. 2,174 billion is going to the cash transfer. So that will put up some pressure on the exchequer itself. So, but no, with Delhi election already over, the BJP has already promised to transfer more. So more and more state election is coming up. By the end of another 1 year, and so you will see all the state government are following this thing. So that itself, this number itself will double in next 1 year, and so, and this is a huge pressure on the exchequer. So that's one thing will likely impact in the GDP growth rate. But let's see, because this will actually increases your fiscal deficit. Okay. And so, but anyway, that's a political thing to stay in power in India. Most of the government, any government will be there, they have to do it. That's how they manage it. So we can't do anything in that thing. But that is the one point that you need to keep in mind, that this could be a pressure on the fiscal factor in India. Otherwise, the data which I have shown right now looks a very positive impact as such. Now, how this deficiency, because this is an outflow, right? How this can be matched up. In a budget, the government has also given us some hindrance, some hint. So let's see. Let's see in a subsequent slide, I will put that thing also. FDI inflow have seen a sharp decline, pressurizing private capex. So we all know FDI inflow. India's 2025 economic scenario: stagflation, inflation, stagnation, and Goldilocks. So I will discuss more now. Budget 2024. This is Triveni Shangam: fiscal prudence, consumption, and capital allocation. Now, if you see, the infra stringing is important. Okay, so capital expenditure, if you see, sorry, there has been a little bit of, while presentation, the C actually will be E. Okay, so there is some typo error happened. So that's why you have seen a little bit of this thing. Pardon for that. So when I convert this thing into PDF, I find this thing has happened. But anyway, that was too late for that. But anyway, we'll move on. So capital expenditure, if you see the data, which is a 10% increment, and grant in end of capital asset is also. So you will see the total amount of infra spending is 17%. There is an overall growth from here itself. Now, if you see that 1.3% tax policy assumed, now gross tax revenue, this is a revenue. Okay, gross tax revenue, if you see the number, there's expected increase of, this is FY26 expected increase of 13.51%, after adding 1 lakh crore. Now, nominal GDP, we are all expecting it to increase by 10.13%. So we will have a little bit of tax buoyancy of 1.33%. So this extra nominal GDP increase and extra gross tax revenue increase will actually help us the deficit which we might be having by those state and central government, putting lost fiscal pressure by giving away freebies. So that the government has expected out of that. Apart from that, the government has also, this disinvestment has fallen as the market grows. So a lot of disinvestment thing has not been put into place right now. So government has a huge amount of public companies which they might disinvest to raise more funds out of it. And over the period of time, government, you will see the RBI will expect it to give a huge amount of dividend in the days to come. Okay, so last year we have given a huge amount of dividend. So I think that those deficit which government will be having by giving a freebies can be make up with One with the disinvestment, second with the RBI giving dividend, third with the gross tax revenue, more collections. They will either find ways to get more tax, or they will put something or to hinder the leakages in tax collection that is happening, plus their expected GDP growth that will also bring in more GST collection. So this thing will government is expected to cover up the deficiency that might will having by giving the freebies, a huge amount of freebies, so the billion numbers kind of thing. So that's what government is predicted. I'll give you the data point as far as possible to you. Government is investing in future, small modular nuclear reactor maritime development. So that's government is expected to do, that they have already written in the budget. Focus on education sector. So income impact on tax rebate. This 14 is roti, kapra, and makan, consumer discretionary, and this thing. So tax rebate. This data is important. Although this consumer discretionary, the spelling has been error because of the conversion which I was doing just before coming to the presentation. Sorry for that, but this data, this slide is important because this slide will give you an indication where the market, which sector the market is going to impact, and where you can see the growth will happen as far the individual stocks goes. So I will not mention any stock or mutual funds because we are devoid of speaking in front of open forum. But because of the tax rebate, 12 lakhs, there is no tax to be paid. So we expect the roti kapra makan, the expenses will increase. People will spend more on travel, tourism, healthcare, and entertainment. So these are the sector which you should look into. Good stocks, good fund house, which are offering products into these sectors as an investment avenues. Okay. Beyond budget, so liquidity infusion, interest rate cut, credit push. So interest rate cut already we have seen. Liquidity infusion we have already. This is an RBI measures. So credit push, I already told you, the credit push has to be there because of RBI measures that they have inputted. Because of rate cut, the liquidity has more been pushed in the system, and in this year, I am expecting 2 more rate cuts to happen. With the more rate cuts happening, you will have more liquidity in the systems, and that will push the credit into the market, and the corporate profitability will increase as such. Why increase? Because obviously, when you have more liquidity into the market, people will buy more. The companies will have more funds to spend, and that will actually increase their top line and bottom line both. Important factor is that in ease of doing business, we have Jan Viswas bill, and in 2024 we have reduced compliance of 180 thing, and in 2025 we have 100. The compliance cut is happening. So that's good thing because a lot of new companies, a lot of startups will have easier to do business in India. 10 years back, if any startup wants to do in business in India, and today you want to start, the lot of compliance cut has been happened. So those who are into startups, those who are into business, they will understand what I'm saying. So this will actually help us for more new companies, younger companies to build up, and this will actually give more, employment opportunities as well as revenue generations of the Indian markets. So let's talk about Indian equity market now. So we have discussed about US, we have discussed about global, we have discussed about Indian economy. Now talk about the Indian equity market. Market cap to GDP ratio is at all-time high. This actually tells us average is at 87 approximately, but we are right now 132. So it is higher side. Okay, so this tells the market is costly. But the next slide, market capitalization and profit after tax both are on the upside. So if the earnings is higher, then you don't have to think about the before data which I have shown you. So earnings, if you see the FY 2020-26, it has been consistently increasing. Okay, so the market cap and profit after tax is constantly. If the earnings increasing, then you don't have to worry too much about the market cap as well as this data, because if you see, this is average of like 18 years, but if you see the average of last 5 years, this 87 will move up. Okay, so data has to be looked in a different angle also, but this data point clearly tells you, we have the market cap as well as the profit after tax is also increasing, and that is the reason this time we have also seen the market cap to GDP increase. So don't see from the angle that this data in isolation, if you see the Indian market will look costly. But if you see profit after tax is increasing at 327%, market cap has increased 275%. So that means market cap is yet to reach this profit after tax level. So in that sense, right now, sorry, market is not that costly. uh, uh, Overall, I'm talking about, it has corrected a lot from the top level itself, and that is the reason, see, 322% profit, this has to match. So in that way, it is still in a better level right now. So as an investors, when we have already seen 15-16% corrections, it's a good time that you start accumulating money, invest in different asset classes based on your risk appetite, but not in a one go. Okay, so we can see next 5 to 6 months market volatility or downfall from here because of the Trump factor, which is happening, all the steps that is taking. But we now, this data tells you that we are on a better off position right now as far as the profit after tax and market cap goes. Obviously, which stocks to pick, which funds to pick, that you have to discuss separately. I'm not going to tell you right here. And yes, there are some stocks, there are some funds which are costly, which I will show a glimpse of it in a subsequent slide. That's what I'm talking about. Nifty PE right now is 6% premium. So Nifty, which is a large cap, is 6% premium. But if you see the small and large cap, it is 25 and 32% premium. So that's what is exactly mean that if you're buying a share, you're buying a 30% premium right now. Will you buy that? No. Okay, that doesn't mean that you do not pick up small and mid cap companies. There are companies which are valuation are less, that you have to find out. There are fund houses which are easily, which are a lower price right now. So that you have to pick up. But overall, large cap looks very attractive right now. All the top large cap companies, they are at 1 year low price prevailing right now. So it's a very lucrative thing, because FII mostly invest in large cap. They have moved out of the money from the large cap itself. So this data clearly tells you that large cap looks attractive. Earlier data also tells you that profit after tax has exceeded the market cap. So that tells you that why I am telling you large cap looks extremely good to enter right now. Okay. Earning expected to remain robust will market cap follows. Moving on, FII records second highest ever monthly outflow in equity. So this is the equity outflow which has happened on the FII. We all know why FII already moving out, because US market has outperformed. Rupee has been depreciating because RBI is buying, dollar itself. And US interest rate is high. Obviously, if you get an interest rate at 5% in US, whereas the interest rate in India is 6.5%, you will obviously buy in US, because the exchange value isn't also there. So there's a huge amount of outflow happening, and that's the reason. Now this FII, all this money which has been gone out, I told you, there has been an insider sale happening. The US equity market is already extremely higher than is expected. So this will come back. Okay, so this will come back when, we don't know, but when it come back, you will not able to hold the market that time. You will crib that why I have not bought at 76,000 Sensex level. Okay, so that's what I'm saying, that start buying at not at one go, but obviously eventually over a period of time, with asset allocation in mind. Discuss with your professional advisors where we need to invest in, and that's how you should go, because the data clearly tells you that coming 7-8 months or 1 year kind of thing looks very attractive from India perspective. FI flow trend across emerging market and DM. So see, this is the data point where FII has across all market, there's a move. They have moved out. Okay. Now, see, because to satisfy Trump, OpenAI, SoftBank announces 500 billion US-based AI data center network to create thousands of jobs. So that's what Trump has already told to their people, that they will create employment and all those things, and they all told their big short companies to come and settle business out there. So that's what is happening. SoftBank is moving out 500 billion and creating a database out in US. So obviously that's the reason why the market will fall. But economics is a bigger power than any individuals or a government. When the bond yields would not support what is happening out there because of the higher interest rate. So because of the higher interest rate, the equity market in US is not stable right now. Okay, so only time will tell what is going to happen, but I told you the data point here itself. So nothing to worry that we have corrected so much. We may correct a little bit more, but this is a good time to accumulate all the funds, all the shares, good funds and good shares, as far as the valuation goes right now. So I just quickly move on with the data. FPI outflow are large but not substantial. FPI selling during entirely large cap while buying in small caps. DII monthly flow. This is the domestic investors monthly flow. Obviously, DII keep on investing. Domestic institutional investor keep on investing in this period of time when FII is moving out. DII is amniotic and FII is selling. So Indian share of global market cap dips to 3.6%. Okay, so this is the Indian share to world market cap. So it was in July it was 4.6%. Now it is around 4% right now. The why? Because of more money has moved towards the US. Okay, so US market cap, US share to the global market is 60% right now. So that's a huge. So that's what's happening. So that's the point. Indian average valuation premium over emerging market below 5 years average. So this is India, this is emerging market premium. So see, the Indian average is at lower side right now. Okay. So Indian market looked attractive right away. FPI holding an Indian equity at decadal low. Where will you invest? So if you see the investment in Nifty 50, S&P 500 and CSI 300 index, India, US and China. So if you see the PE ratio you see the data point here itself. So India looks although in a lower range, but if you see this is the level. Okay, this is the level out here itself. So this is the 3 level, and in May, in December, in July. So if you see the data point here, it is average 10-year, average PE. Okay, so 2016 EPS and 2026 EPS. See the EPS earning, expected EPS earning in India, that is huge. So if you see this data point out, still EPS growth in last 10 decades. So see the data point. So this, although you have seen there's a last 10 decades, India has the highest number of EPS growth. Okay. But still market, if you see the market Indian market has not moved up as such. So this clearly tells you that Indian market vis-a-vis the US and China market will looks attractive in days to come. Okay. So sectoral concentration, I will not be putting this thing much emphasis here. Many stocks are delivered return. Many stocks are trading as expensive valuation. So that's one important point. Like, although I recommend you to go and invest in large cap and funds and all, but beware of the stock valuation. There are some stocks which have been overvalued right now. Nifty 6% premium. Small cap index 30% premium. But in Nifty also you will find some stock expensive, some stocks cheaper. So you have to figure out which stocks are cheaper and expensive, both in a small cap and mid cap and large cap segment. Okay. Moderate return expectation, I just quickly move. Growth as per market capitalization. Okay, be ready for volatility because of main point I've written here is that Trump, oil, government, consumption, geopolitical risks, earnings will be taken care of mostly by the government, Indian government and RBI. But Trump, we highly unpredictable. Although he has been predictable in the last 20 days as far as his policy goes, but be ready for volatility for at least for the next 5-6 months. Okay, so don't crib that if the market fall 2 to 3,000 in Sensex level from here itself. That's normal. Neutral to equity, I told you have to be overweight in large cap right now. Mid and small cap, you can book profit out of it. But you are running in a SIP. If you're running in a SIP in mutual funds or SIP or in stocks in a small and mid cap, do not switch, do not stop. Keep accumulating at the lower level, keep compounding at a lower level, keep rupee cost average in a lower level itself. That will help you when the market turn around 8, 9 or 1 year down line from the here itself. You will see a massive growth once you accumulated all these funds. So do not stop, do not redeem money right now. If you do not have a requirement in next 1 or 2 years kind of thing, keep accumulating. But in case if you have a lump sum money, put into a small and mid cap right now, so you can book profit right away, because there can be erosion of 10-15% from here itself in a small and mid cap category, not in the large cap category over say. Okay. Large cap contribution is the lowest thing. Top 10 companies contribution to the market cap. So I just quickly, so that's the debt market outlook. Debt market, I already told, US inflation stays firm. So see the US inflations. Okay. So this has been increasing. This will increase. The Biden administration has done a lovely job in reducing the US inflation, but we expect, this data has been increasing right now. So the price will increase from here onwards. Future rate cuts dependent. I just quickly move because we have discussed more about the market in the debt segment, and Indian inflation has been lower. See, the Indian inflation has been lower. It has moved up a little bit, or it can come down, and this is the reason why in the last 2 quarters, rate cuts was not happened. But since it was reduced, the rate cuts happened in this quarter itself. Biden inflation projection. Okay, so I just quickly move from this. So invest in duration. So since I told you that there could be a possible rate cuts happening, 2 rate cuts happening in this time. So if you are investing in bond, invest in a long duration bond paper. That will give you a bond advantage. When the interest rate rises, the bond prices goes down and vice versa. So that's the advantage that you can have, because it's inversely proportionate, the bond interest rate and the price. So if you are looking for a bond investment kind of thing, invest in a long duration paper with 2 rate cuts expected happening in next 1 year, and so you will get a double-digit return in government bond also. Gold price, yes, we have seen why the gold price had increased, because US debt and surpluses US GDP from the 2017-18 onwards, and that's the time when you start seeing gold outperformance. So we expect gold and silver both to continue momentum from here itself. So if you have invested in gold and silver, you should invest 10% of your total asset in gold and silver. Okay, so I don't know how much you have, but you should. There are gold ETF, silver ETF available out there to exposure. Although we have seen the market moved up, but although there are some correction happening, but we expect silver especially to move from here itself. But not overexpose in those 2 asset class. So I just quickly move into this. Okay, so there has been annexure. Nothing more to say out here itself. So if you see the data, so to summarize, we are in a last age of our presentation. So on a summarize that, if you see Nifty earning expected to grow at 3% in Q4. So I have seen sales growth, EBITDA growth, and profit growth across all segment. YoY sales growth, if you see, this is important. If you have a top line and a bottom line growth, see this media, have a top line, bottom line. So if you see a company having a top line as well as a bottom line growth, then you know what the stock price is going to happen, because stock price is actually a slave of their earnings. So this profit after growth and EBITDA, this you will see carefully about different segment. You will understand which segment is outperforming right now or may outperform right now in days to come. Right now, all thing is momentary as far as the global market and the things which I've told you right now. Okay, so to summarize right away, what we are saying that if you are have a if you're looking for an investment right now, so keep asset allocation in mind. So suppose if you have 3 to 4 years of duration in investment, go with a bond investment. 2 to 3 years bond investment will be better. But if any asset class, if you're looking into any investment you're looking into with a 5-year plus duration, definitely go with mutual funds or equities. Take advice of your professional advisors. There are some stocks, there are some funds which are at attractive level right now. To take advantage of that. Market has corrected 15%. It may go down somewhere or other. We do not know how much it may go down. But with the FII going out and the US market, I told you the scenario and global economy and scenario kind of thing, they are bound to come back to India. When they will come back, we don't know. But when they come back, you will not able to get hold of the market. So don't invest right away. Invest in the next 2 to 3 months. Spread your investment in the next 2 to 3 months and keep asset allocation in mind. 2 to 3 years duration, you go with debt investment, 3 to 5 year duration, take an kind of hybrid kind of product. And if you're looking for a 5 year plus, definitely go with an aggressive equity product. Equities or mutual funds, whatever, there are opportunities lies there. There are funds, there are stocks which are available at a much cheaper rate right now, which are available now in comparison to 1 year back, what they are into. Okay, so that's what in my overall presentation. Next month, in a March, we will be having a session in Delhi, offline sessions. Those who are in Delhi, they can catch me out in 15th March. In days to come, I will send you the invite. Those who are in Delhi, they can catch me out. We'll have a little discussion out there face to face, and we'll see what's happening during that time. So thank you for attending today's sessions. And those who have registered, they will get recording. Those who have not able to attend today, they will get recording. Keep following me. We'll catch up next month also with online market updates. And for Delhi audience, we'll have an offline seminar where we will discuss more about market, economy, trades, globals, and everything. Thank you. Stay healthy, stay safe. That's from my side. If you have any query, drop me in my WhatsApp. I will get back to you. Thank you.